Welcome back. We had a slew of numbers that came through post-market hours on Friday, and let's just take a look at some of them. Karur Vysya Bank posted a good set of Q2 earnings. The net interest margins expanded to 4.07%, which is an 18-quarter high for the bank. And this is driven by a robust loan growth and slippages, which have declined to a 7-quarter low. B. Ramesh Babu, who is the MD and CEO of Karur Vysya Bank, joins us now. Mr. Babu, good morning. That's been the common thread for most banks this quarter. A very impressive loan growth and stability in asset quality. Tell us a little bit about this net interest margin expansion that you've seen. What is driving it at an 18-quarter high now of 4.07%? Will it get better in the second half of the year?
Yeah, good morning, Sonia. Good morning. So, yeah, it's a very good quarter that way. What we can say, the profit also 250 crores, which is the highest in 106 years a quarterly profit. So the main thing, the advantage we got is the cost of deposits. Cost of deposits we are able to maintain at 4.08, which is one of the lowest, and our yield on advance also has improved pretty well. So that's the reason we are able to get. Another advantage what we got is the negative net slippages for the last 5 quarters. So that is the reason the reversal of interest has come down. Our SMA 30 plus also is one of the lowest. It is at 0.66% now. And the corporate, which used to be a pain point and lot of reversals used to be there in the book. So now the corporate 30 plus is 0 at the end of September. So all these things have supported us actually for the NIM of 4.07.
Mr. Babu, your low-cost deposits, current and savings deposits as a percentage has fallen slightly to 35.2% of your total deposits compared to 36.4% in the previous quarter. Clearly, it is becoming a little difficult to get people to put money in savings deposits. People are probably asking for term deposits. So would it be right in saying that margins may start to plateau or fall in this or next quarter?
Yeah, absolutely, you're correct. The reason is the few of the deposits what we were having in savings bank also, they moved to current term deposits also. This is also one of the reasons and all. That is the reason we have been giving a guidance of 3.8% as NIM, though it is 4.07 for this quarter. So what we feel is over a period of time it gets equated. So we may have the benefit of the interest rate hike on the advances now, but with the spike what is coming up in the cost of deposits over a period of time it gets narrowed down. So all our working what we are doing is with a NIM of 3.8. That is the reason we are giving a guidance of 1.2 also for the ROA for the exit quarter based on a NIM of 3.8.
Okay. The other thing about your asset side, SME loans have grown about nearly 15% year on year. Agri loans have grown about 17%. There is talk of a rural slowdown. Everyone's talking about a K-shaped recovery. FMCG sales are not doing well. Would you worry about asset quality over there?
Yeah, in fact, what we did is last 2 years, luckily during the COVID period, we did a lot of homework for cleaning up the portfolio. So many of the exit market accounts we have left, and that way the portfolio has become clean. Now, if we say that our 30 plus is 0.66, it's an effort made for the last 2 years. So that way, when our net NPA is 1.36%, which used to be around 5% 2 years back. So once we want to bring it down to below 1% also by the end of this year, so we will have some headroom, even if these sort of issues can come up also. So our recoveries will be able to manage. So the slippages, last 5 quarters, if you look at it, we have a negative net slippages. So this quarter also, we did not make that much of profit. Prudentially, we have made to clean up the balance sheet because it's one of the best quarters we had, and we wanted to take advantage of this quarter. So, however, if you look at it, our portfolio more or less, the digital portfolio, what we have got it from 2018, all our loans, MSME are booked through digitally. So with so many checks and balances.
Okay.
If you look at these stress here and all, it is less than 0.75, we are able to find that. So which we are able to manage pretty well. Pre-digital 2018, we find some stress, but post-digital, it is relatively much better compared to the pre-digital. So that's why we feel that it may not have a big issue for the bank.
Okay, all right. Mr. Babu noted a couple of numbers there. NIMS should stabilize at around 3.8%, and the ROA is moving to around 1.1%. That's something that the street was waiting for, and you're trading at around 0.9 times price to book. So maybe it gives you some valuation comfort as well. My question to you is on the loan growth. What kind of a number should we be working with for this year? And also jewel loans as a percentage of your total loan book, I think it's moved to the mid-20s. Where do you see this number stabilizing at? And also, what kind of yield you're getting on this part of your book?
Yeah, if you look at it, overall loan growth, we have given a guidance of around 15% will grow. And if you look at the quarter growth year on year, if you look at it, 16%. And post write-off, it has come down to 15% that way. So coming to the jewel loan, if you look at it, for the last 4-5 quarters, it is 25% of the book. So though initially we thought saying that it can go up to 30%, so we wanted to restrict between 25 to 30%. So that the two advantages. One is we will be getting a yield of 8.5 on the jewel loan, but we'll also get the benefit of priority sector. So the surplus, what all is there, we'll be able to dispose of in the form of a PSLC also. So if we add it back, the yield will be better than 8.5. So that way, agriculture is also doing well for us, not an issue.
Okay. We'll leave it at that, Mr. Babu. Thank you very much for joining us with a wealth of details, and have a great Samvat 2079 as well.
Thank you very much, Lata. Thank you. Thank you.
We are staying with the banking theme, and another bank that reported numbers over the extended weekend is Yes Bank. High provisions have dented the earnings momentum, but loan growth also a bit muted. But there have been a lot of strengths in terms of reduction of NPAs in particular, and slippage ratio coming in much lower. Prashant Kumar, the Managing Director and CEO of Yes Bank, joins us now. Good morning, Mr. Kumar. Thank you very much indeed for joining us, and season's greetings from all of us. A great Diwali to you. Well, to get down to business, you have looked like used a good quarter to strengthen the balance sheet, to provide more. But is this the highest in terms of provision? Can we expect lower provisioning from coming quarters?
So, Lata, if you see like our credit cost, we are able to contain around 60 basis points. Okay. This was one of the quarter where two accounts, there was an aging related provision amounting to 750 crores. But going forward, this kind of aging kind of thing we are not seeing. Okay. And the credit cost would remain under guidance. This was more related to only two accounts. And if you just take out these two things, you can just estimate what would have been on the net profit side. So I think this is not an issue, and we are not reading too much into the profit after tax. But I think if we see in terms of the core parameters, everywhere there has been a significant improvement.
Mr. Kumar, good morning. Happy Diwali to you. Your NPAs still remain at elevated levels. This shift of assets of up to 48,000 crores to ARCs, how will it help? And at a time when most banks are seeing an improvement in asset quality, your bank fails to see that. Can you explain why?
No, I really don't know which figures we have seen. If you see our slippage continuously coming down, our net NPA number has come down to 3.6%. Our gross NPA number has come down to now below 13. We started this journey with a very, very large NPA pool. And if you see, there has been a continuous improvement, both in terms of NPA number coming down, also in terms of slippages continuously coming down. So I think there has been a good traction. And once the transaction on the ARC would happen, our gross NPA number would come down to 2%, and net NPA would be around 1%.
Okay. No, my question more was to compare it to some of the other banks, but of course that comparison is not valid. You're still sitting at very high NPAs, gross NPAs of almost 13%. But yes, it's come down compared to what we've seen earlier. So you said post this, your gross NPAs will come down to how much? 2%. By when? What kind of a timeline are you looking at?
So we are expecting this transaction to be concluded within November.
Okay. Let me come back to assets and liabilities. Deposit growth, very good. You think you can maintain this pace? A quarter-on-quarter growth of 3.5%. How does it look to you?
Rather, like if you see in terms of deposit growth, say 13%. And the best part is that our current account growth is 21% and saving account growth is 18%. And the real advantage which is coming to us is in terms of the average current account growth. Average current account growth is 38% and average saving bank is 30%, which is actually helping us in terms of reducing our cost of deposit. And you must have noticed our cost of deposit has actually come by 10 basis points, whereas our yield on advances has gone up by 50 basis points.
Do you have, CD or wholesale borrowings at all which you can bring down?
So CD deposits have already, like if you see as compared to the even previous quarter, has come down by 3,000 crores. So today we are carrying a CD of around just 1,500.
Okay, not much.
On the loan growth side, your loan growth has improved quite a bit. I mean, compared to a degrowth for the last at least 8-10 quarters. Now, for the last 5-6 quarters, it's been a growth of around 3%, now then 8%, and in the quarter gone by, about 11.5%. What do you see as a sustainable loan growth for Yes Bank in the second half of the year and by the end of the fiscal?
I think a loan growth of around 15% is something which we would be able to achieve without any issue. Because if you see, in our retail has grown by 43%. MSME has grown by 19% and mid-market has grown by 32%. So overall, there has been a very good growth. It's only like degrowth on the large corporate, which I would be saying some strategic calls and some, I think, the welcome repayments in some of those loans. So I think this combination resulted into 18% degrowth on the large corporate, which is not going to happen going forward. So overall, a 15% growth on the loan side, but definitely it would be having a higher proportion on the retail, MSME and the mid-market.
Okay. We hope so, sir. We hope so. If the economy slows, mid-market takes the hit before large corporates. But we do hope it doesn't slow to that extent. Just coming back to that ARC transaction, can you just tell us exactly all the changes that will happen to the P&L and balance sheet? I guess balance sheet also shrinks, right? GNPA also shrinks. What will be the changes? Security receipts go up?
So on the balance sheet, since like 84% provisioning is there, okay? So on the net side, we are not going to see any impact, okay, because of this provisioning. On the P&L, like if we see the construct of the transaction, 15% would, as a cash would come to us immediately. Okay? And remaining 85% would move from the NPAs to the NPIs. But going forward, there would not be much change on the P&L. But the best part is that since a very large book would be going out of the bank, our PSL requirement would significantly come down. Because the PSL requirement is calculated on the basis of the gross NPAs. So I think that would really help us in our profitability also.
No, but this 15% that you're getting for the upfront sale of the assets, you will reinvest as equity in that ARC, correct? Is there any write-in also?
That would be a very small amount. I think the equity contribution from the bank, even for 19.99%, would be somewhere between 300 to 350 crores.
What will be the net write-in?
Whereas the 15% which we would be getting would be something around more than 1,000 crores.
Oh, okay. So there is a 600 to 700 crore that comes directly to profit, right? Okay. We'll leave it at that, Mr. Kumar. Thank you very much indeed for joining us. And we do hope 2017 is a great year for you and for Yes Bank.
Thank you so much.
Okay, well, markets at this point in time, clearly, it's been a jagged edges market, flipping in and out of the red. But important that it has maintained green, where other Asian markets have not succeeded as much in keeping to the green.
I would think that the headline index is not telling you the real story. There's lots happening that's beneath the surface as well. I mean, there's profit taking in names like Kotak Mahindra Bank, there's HUL. Despite good numbers, Kotak Mahindra Bank is seeing some profit taking, and we were speaking about how the deposit growth there is a bit muted. But on the flip side, there's so much buying interest in some of these names. United Spirits is now your top mover, up 3.5%. KPIT Tech, NHPC, JSPL. So there's plenty that's happening. Mitesh Thakkar, in fact, is with us. Mitesh, indices are back in the green, and the good part is they're consolidating their gains around the 17,750 mark. What's the strategy for the rest of the day, and what are the stocks that you're looking at?
Morning, Sonia. Yes, that's a good thing that we haven't seen much of a drop. But I think, as I said earlier in the day, getting past 17,800, 850 will be a tough task. So we have taken profits on long positions on the index, hoping that, we can get an entry point closer to about 17,700, 17,680, which would be a very aggressive entry. And then you can take about 100-point kind of stop from there and then look for a retest of 17,850, maybe a break beyond that. So trading with more of positive bias, though I think in the short term or immediate basis, we have taken some profits and have explored some minor shorting opportunities as well. For the time being, I have a buy on Dr. Reddy's. I think that's a stock which has moved up very nicely and given a good breakout. Buy with a stop below 4,400 for targets of around 4,550 here. And on the sell side is Indus Tower, which I recommend selling with a stop at 192.5 for targets of 180.
Okay.
Actually, JSW Steel is thanks for that. Mitesh, do stay on. Couple of questions more. JSW Steel is a remarkable performer today. Probably enthused by what Mr. Rao said in terms of the raw material costs will go down or have already gone down.
Yes, costs have gone down, Lata. The problem is that it didn't flow in the past quarter.
It didn't flow.
So now it will flow in this quarter. Just to give you a number, the coking coal cost was down by $40 in the past quarter. And in this quarter, it will go down by $80. That's what he told us. So you're talking about in 2 quarters, it goes down by $120 per ton, which is a big relief on that front as well. So that could be one of the reasons out there. Just to point out a couple of other names, South Indian Bank, in 2-3 days, the stock has gone up 20%. It's only a 10-11 rupee stock. But that one seeing traction even today, even yesterday.
Very good set of numbers.
A very good set of numbers, and it's being rewarded. It's up 8.5%. And I think if we pull up the last one week chart, you'll see it's moved closer on 20%. So that's one stock. The other one is Rajratan Wires. We remember that we were talking about this company, that it is, a play on the tire space. What happened midway through was it became more expensive than tire stocks. And the stock is down 3.5-4% today. And in the last 2 months, it's down from around 1,400 to around 850 odd. So some of these plays, when you have a large share of the market share and the play was on tires, suddenly, in fact, it got more expensive than tires. And that's why I think the street, post its numbers, it's seen a big correction. Pull up a 1-month chart, I think it'll give you a better picture.
I just wanted to ask Mitesh, Mitesh, today has been a good day for auto stocks. Maruti, Tata Motors, Eicher, all of them doing well. Of course, they have been doing well. Is there any tactical pick over there?
Morning, Lata. Good to see you after a long time. I've been, pushing for Eicher and Maruti to a certain extent. Both these stocks, one are in medium to long-term uptrend. But between the two, if I was to look at a trading bet, Maruti looks very interesting. It went about 9,500, corrected from there to about 8,500, and now is breaking out. So I think Maruti can be bought immediately with a stop below 8,800 for the time being, and I think a target of around 9,350 to about 9,400 is what traders can look at.
Okay, by the way, a lot of banks are hitting fresh highs today, 52-week highs. That is Canara Bank, Bank of Baroda, ICICI Bank, SBI, Federal Bank, all at fresh 52-week highs as we speak. So the headline index is not telling you the real story. There's plenty that's happening beneath the surface on the buy side. Let's slip into a quick break. Thank Mitesh for joining in. Manisha Gupta will be putting focus on the commodity markets when we come back, so do stay tuned in.
Welcome back. Well, the Nifty was drifting towards that 17,700 odd mark. Now it's making its way to around 17,800 odd. So that's pretty good news from a bullish perspective. But for the time being, let's give the equity markets a bit of a break and shift focus to the commodity markets. Manisha Gupta is here to tell us about that one commodity she's tracking closely. Morning, Manisha.
Morning, Nigel. Thank you for that. I'm looking at the metal prices, and within that, I'm looking at steel because that one is trading at a 2-year lows. Overnight, we've seen 2.5% of a decline onto that one in the Chinese markets there. The Chinese investment in the property sector is down by 8% in this year until now, and that continues to weigh onto the prices there. Apart from that, there also is a World Steel Association report suggesting that in this year, the steel demand will decline by 2.3%, and they expect weak demand continuing in the next year as well. And then you have weak business activity indicators that you saw come in from Japan, US, European Union. That continues to weigh in as well. What the markets, though, will watch out for is the third quarter US GDP numbers. That data releases on Thursday. So ahead of that, markets are expected to be quite choppy there. I also want to bring on screen on what the steel prices have done until now in this year. So we started with a high of 4,540. We did see a high of 5,209. But as of now, we are trading at the lowest point of this year and a 2-year lows as well at around 3,631. But an interesting report to put on 1/4 is the Goldman Sachs report that came overnight as well, which says that they are bullish on commodities. It's a must-have in portfolios, and they expect the next 3 months, 6 months, and 12 months all the way look at commodity as a sector to continue to give you returns in that sense. I also want to break it down to commodity-wise as well, which Goldman Sachs says that they expect 46% of gains coming in case of energy. Base metals is 29%, and they expect precious metal prices to continue to gain as well. And I have to tell you, I was doing the Mahindra trading show yesterday, and in that one as well, almost everybody said that energy is a must in your portfolio. $75 to $100 a barrel is what you can expect in the next coming 6 months as well.
Okay.
It's not looking very good from a macro standpoint.
Not looking good at all. So are you talking about a must in your portfolio? I was listening to S. Narain of ICICI Pru, and he mentioned on Anuja's show that for the first time in decades, he's recommending gold and silver in your portfolio now. Yeah. So, I mean, that's kind of the asset allocation that we're looking at. Not just stick to equities, but perhaps look outside as well. Let's do one thing. Let's get back to tracking stocks. Ekta's with us. She's tracking RBL Bank and IDFC First Bank this morning. Ekta, over to you.
Thanks. I'll start with RBL Bank. The NII was up around 16%. The profit was also higher on account of a low base and was supported by the fact that provisions declined quite considerably to around 240 crores versus 650 crores. Net interest margins came in at around 4.5 versus 4.36% on a Q-on-Q basis. So there was some improvement there. But RBL Bank is really, reacting to its operating earnings, which have been impacted this quarter. So operating profit is down this time round by 25.8% on a year-on-year basis. It is the 5th quarter of a year-on-year decline when it comes to the operating profit. The bank, in fact, has guided for moderate growth in operating profit in the near term. Slippages also increased, 812 crores versus 653 crores. Annualized slippage ratio is now above 5% for the company, for the bank, and the advances were around 12.5% on a year-on-year basis, which is lower in terms of the average that we've seen other banks report as well. The bank expects credit growth to remain around 15% for FY23. IDFC First Bank, NII up 32%, profit up again on account of a low base to 266%, which was really aided by another income, which was up 36%. Provisions, which were lower by around 11% on a year-on-year basis. Again, for this one, the operating profit probably disappointed a little bit because it was up close to 69% on a year-on-year basis, and slippages continue to remain elevated at around 1,100 crores plus. Annualized slippage ratio, 3.5% for the bank this quarter.
Thank you very much for that, Ekta. Take your point on both the banks. RBL, my worry would only be that deposits over the quarter have not grown at all. It's flat. I mean, it's a 0.2% growth. That's the tough task Subramanya Kumar faces. The tough task that Prashant Kumar faced when he came to Yes Bank. And now Yes Bank's deposits, I think, grew by 4% quarter on quarter, 13% year on year. It's not easy when a bank has done badly to attract depositors back. Prashant Kumar has been able to do that after a Herculean 2-3 years in Yes Bank. Now, I guess it would be Mr. Subramanya Kumar to do that in RBL Bank, to attract the depositors back. That's the tough task. Giving loans is a bit easier compared to that. Okay, let's get to the other good performer in terms of Q2 numbers, MCX. Surabhi is here with an analysis of the Q2 numbers. Surabhi.
MCX reported a very strong set of numbers. It was a top-down beat. The revenue was up 53%. The EBIT nearly doubled at 60 crores versus 27 crores same time last year. The margins came in at 47% versus 33%. The PAT was up 94%. The average daily traded value for futures, that was down 7% on a year-on-year basis. But in the option segment, it was up 5 times at 31,000 crores. The options daily traded value growth has majorly come from the energy basket. The con call is at 4 p.m. today, so we'll get more details then.
Okay, thanks a lot for that. So that's an MCX. But clearly the stock of the moment is ICICI Bank. Fresh record highs there. Ekta is here to tell us about the blockbuster numbers. Ekta.
Well, yes, it's a record-breaking quarter for ICICI Bank on a lot of statistics and a lot of parameters. So NII up around 26.5%, profit up 37%, global net interest margins at 4.31%, which was an all-time high. Gross NPAs also were at the lowest in 31 quarters, so it came in at around 3.19% versus 3.41% as a percentage of loans on a Q-on-Q basis. Slippages low at 4,366 crores versus 5,825 25 crores. Loan growth at a 27-quarter high, so it was up 22.7%. Now, in terms of the brokerages, the likes of Citi, HSBC, they've all raised their target prices. They have a buy call on the stock in any case. Nomura has a buy with a target of 1,060. Morgan Stanley overweight with a target price of 1,250. Now, the key brokerage takeaways are that the pole position of ICICI Bank remains intact. The key highlights were strong loan growth as well as the net interest margin expansion. The core pre-provision operating profit beat estimates, and a ROE should sustain, which is the return on equity should sustain over a medium term, and they expect the earnings consistency to continue as well going forward.
Okay, Ekta, thanks a lot for that. We will slip into a quick break. Up next, Anup Maheshwari, the co-founder and CIO of IIFL Asset Management, will be joining us to give us an update on the markets and what he sees as the way forward.
Welcome back. It is the start of the Samvat, and therefore we're not discussing economy. We are going to discuss markets, of course, built on how the economy is panning out. And we have someone who has observed both very closely for a very long time, I think 3-4 decades. We have with us Anup Maheshwari, co-founder and CIO of IIFL Asset Management. Of course, we know him from previous avatars as well. He has been on a bit of a banvas for the last 4 years. We haven't seen you, Anup. So thank you very much for coming to our studio.
Thanks for having me.
Okay, let me start with the micro and then go to the macro. But can you tell us about IIFL's asset AMC piece itself? We don't get to hear too much about the MF piece. So tell us, what is the MFPE AIF split, and how have each of these pieces been doing?
Sure. Yeah, so IIFL, I mean, we've been growing a bit quietly over the last 3 to 4 years. I came in 4 years ago. And we're the leading alternates player now in India. Alternates is becoming a bigger and bigger part of global AUM. More importantly, if you actually look at global AUM and revenue, it's pretty interesting at an international level. So global AUM is about $100 trillion, and global revenue on that AUM is about $330 billion.
Oh.
Now, alternates is 15% of global AUM, but 45% of global revenue. So it's the most profitable piece in asset management. And that's the area we are focused on. Alternates basically mean everything that is unlisted, illiquid. So within our alternates book, we've got private equity. We're one of the largest domestically sourced private equity firms. We have structured credit, which is a very interesting business, high yield credit, real estate, residential debt. And we also have a public equities piece. Okay. So all put together, we're about 56,000 crores of assets. We've grown quite strongly over the last 4 years. We were about 13,000 going to 55, 56. And within that, our alternate investment funds, that structure is the largest piece. That's about 30,000 out of the 56,000. So it's been pretty nice. The last 4 years have been good, and it's very exciting to be in this space because it's growing quite rapidly in India as well.
What has that returned?
So the alternates across various books, private equity has been somewhere in the 18 to 20% IRR range. Listed equity is doing quite well. We're sort of in the top quartile decile. Okay. And on structured credit is also decent yield. So all the books have done quite well so far, but it's a young track record. I mean, there's a long way to go.
No, I agree. And especially funds like these, structured credit, you have to look maybe at a longer period. But Anup, now let me come to the macros. What's the sense you're getting in terms of global equities? We've seen some kind of a bottom formation in the big markets, in the developed markets. Do you think that the worst is over, or is this just a bear market rally?
Sure. Well, it's difficult to say the worst is entirely over, but the fact of the matter is a lot of the concerns that we have, are well understood now. I think people broadly understand at least the economic concerns. Geopolitics is a very different topic, but the fact of the matter is that a lot of that is represented also in global markets. Valuations have come off to more meaningful levels. We've gone through the interest rate hike cycle. Everybody is expecting a recession already. So, the good thing is sort of within
It's
24
priced
hours,
in.
everybody has the same view pretty much. And it's fairly priced in. So there is a chance, of course, things can get a bit cheaper over time. But I think the bulk of the impact has been felt already. So it's really in increments now. And in these periods, you're much better off doing bottom-up investing than taking too much of a top-down view.
Okay, so let's come to sectorally. Since you are anyway engaged in several of the interesting sectors, let's start with real estate. Is there a lot more opportunity in the listed space, or has the market already priced the fact that we are at the start of a good real estate cycle?
Sure. So real estate, to be perfectly honest with you, it's not an area that we've focused much on in our portfolios, for the simple reason that we struggle to find companies in that sector that are capable of delivering more than a 15 to 20% return on equity. Just the nature of that business is such that they don't really produce high return on capital, because a lot of it gets redeployed into buying fresh assets. So it's not a sector we've really built much in the portfolio. But having said that, we've all seen the same trend. It's consolidated, therefore the economics for the larger players are improving. The only concern, I guess, is as rates start rising, and interest rates are rising here as well, that tends to obviously have some impact incrementally in terms of demand. It's bound to have some impact on demand at some point in time. So I guess there are a couple of good choices in the sector, but frankly, we don't hold any right now.
Okay, well then let me not try and guess the wrong sectors. You tell us, where are the opportunities now, whether it's AIF or the listed space, preferably listed, because that's the viewership.
Sure. So, the largest sector in India, and it's interesting actually, if you just take the big picture sort of thought process, two sectors in India matter a lot. Financials and IT, interestingly, make up 50% of India's wage bill. If you look at corporate India's wage bill, the BSE 500 total salaries or wages, 50% of that comes from these two sectors alone. And therefore, how these two sectors perform is very important, because that influences the whole consumption cycle and the broader sectoral outlook. So the good news, I guess, is financials is doing quite well. And we've seen from the spate of results last week that things continue to be on a fairly good trajectory for financials. It's 1/3 of our market cap. So therefore, when financials are doing well, that provides some sort of safety net or some consistency to the market. IT, of course, is going through more challenges at the moment compared to last year, and maybe valuations are still a bit above average, so we have to wait for that. But from a business point of view, I think things are steady.
Okay.
So, so from our point of view, financials remains one of the very interesting long-term sectors to, if you're playing India or investing in India, this has to be a core part of your portfolio. Beyond that, we're looking at pharmaceuticals. We have a bit of a soft spot for pharma, although it's not done very well. But I think as a sector, it does tend to create long-term value. So within pharma, we're finding some interesting opportunities. Some of the consumer discretionary names look interesting. So at a broader level, I would say the good thing is it's fairly broad-based. It's not just one or two sectors. It's a fairly broad swathe of companies and sectors. But finally, it's more what you select. So the bottom-up side is more critical.
Yeah, of course. But still, if you can talk stocks, nothing like it. But you have your compliance rules. Finance, I think the top echelons are well-founded. There is very little now to discover about HDFC Twins, or about their merger details, or ICICI or Kotak. If you were to go down the line, will you go down the PSU Bank line, because BOB is at a 52-week high. Canada also, I think, today is at a 52-week high, other than SBI, of course. Would you go down that line? Would you go down the line of NBFCs, or would you go down private sector mid-caps?
So the longer term sort of buy, hold, core portfolio would be around the same private sector banks. I think they've demonstrated more consistent ROAs, ROEs, incremental market share, and that trend I don't think shifts, that continues. For the other parts of the market, I think it's really more a valuation call at a point in time. So sometimes they get so cheap that they're worth owning for a while. Yeah, that's the way we generally see it. The largest public sector bank, of course, comes quite close to the private sector banks in their metrics, so that I would include in this category of private sector. But yeah, beyond that, I'd say we take more tactical views than long-term structural views. I think the core really is that. And they may sound like, the same old boring names, but they've been consistently creating value as well.
So why try and look in the difficult space? Fair enough. Let me come to the mutual fund sector itself. I know you said that it's a smaller piece for you, but now interest rates may start looking attractive, especially of the large NBFCs, the well-run NBFCs. They will start or have already started asking for public money at much better rates. Right. Do you think that the very good run that equity fund flows have seen could be a bit challenged and fixed income could attract?
Sure. No, it's bound to moderate somewhat, Lata. I mean, if you look at last year, the flows into fixed deposits fell substantially.
Yes.
And in a way was redirected partly into equities. And as FD rates go up, it's quite logical to assume that some flow will go back. And mutual fund flows have already started tapering off a little bit. So there's no arguing about the structural trend of under ownership in equities. But yeah, the same velocity, I mean, it might sort of diminish a little bit before it picks up again. So that's bound to happen after a very strong year of flow. And as interest rates rise, then the options start opening up a bit.
Okay. Well, finally, about this K-shaped recovery. The economy is doing well, but it looks like one part is doing way better and others have lost out. Would that be one way in which you choose stocks, catering to those who can, those who, the affordable class, consumer discretionaries, the titans, etc.?
Yeah. So, the K-shaped recovery is nothing but more than a further extension of this unorganized to organized shift that was already happening and has got even further accelerated in a way. So yeah, we are looking at the more larger organized players benefiting. Some of the underperforming parts of the market, like the rural side, rural India has been a bit more challenged of late. But to our mind, that's largely because some of their cash flows have been redirected towards the moratorium repayments. But now that this phase is over, there's a good chance the consumption side of rural will pick up again as well. So I think going forward, we are focused on consumer discretionary, as I mentioned earlier. That's an interesting area, and most of the other sectors that we've discussed. But I think at a broader level, demand, I think, is continuing to remain reasonably okay.
Okay. Well, just a final question, and we have to do this because this is Samvat Times and It's a market show. What's the annual return a viewer can reasonably expect?
Yeah.
I mean, we are at what, 17,700? We have seen 18,400 a year ago. Yeah. But the year ahead looks like a 10% return, looks like a high single digit, or looks like double digit.
Yeah, it's tough to predict year to year. I haven't come across anyone in my 27 years who's got the years right. But I mean, just to put in context, we are slightly above our long-term average valuation. The rest of the world, of course, is way below. So India's premium to the rest of the world is quite high. So we have to keep that in mind. On the earnings front, we are absolutely okay. It looks like we are still in that 14-15% earnings trajectory. I think it's really more a valuation call. Our sense is, we're still on a very good track over the course of the 7-8 year period. It's difficult to predict year to year. Last Samvat was sort of flat at the end of it. So hopefully, as long as it's not significantly down, which is unlikely, I think we're looking at any consolidation rise is great for long-term investors.
Okay.
So yeah, that's the way we are.
Thank you very much. I know this discussion can go on and on, but it's a pleasure having you with us after a long time, and have a great Samvat yourself. We wrap up on this edition of Bazaar. Thank you for watching. Trading ideas coming up for you on Chartbuster.